Good morning, everybody. Welcome to Alpine's first webinar of our 2018 webinar series. This year, you're going to find we're going to be focused on some timely topics such as the new tax law, how that tax law is going to affect you and your clients moving forward. We're going to be talking about some innovative new sales ideas and some creative new marketing solutions that we're going to be coming out with that will allow you to attract more clients. With that in mind, I'd like to introduce our first presenter. For today's webinar, it's going to be Steve Zimmerman. Steve is a Regional Vice President for North American, and Steve has over 30 years of experience in this business and probably has more letters after his name than in his name. So he definitely knows what he's talking about, and I've been working with Steve now for almost a year, and I can tell you there aren't many people in the industry that I defer to with a lot of questions, and I call Steve quite often with questions because he has a very strong knowledge of what's going on in this business. So today, Steve is going to go over with you a new way to look at life insurance and a different way to present it than many of you are using with your client. He's also going to be going through some tools that you have accessible through Alpine Brokerage that will help you present life insurance in this unique way to your client. Now, since today's presentation is being recorded, I'm going to ask that everyone write down your questions and then reach out to your account executive here at Alpine afterwards so that we don't disrupt the recording going forward. Without any further ado, Steve, take it away.
Hey, good morning, Chris. Thank you so much. Thank you for the kind words. Hey, good morning, everybody. Thank you for joining us and spending a few minutes of your day with us. We're going to spend about 30 minutes, and we're going to keep this fairly fast-paced. Our goal this morning is to share some key topics and ideas and concerns on clients' minds in 2018, and we're going to go back and we're going to visit how life insurance and the planning that Alpine can bring to you will help you solve those clients' problems. So often, as many of you, I'm on the road, I'm in front of client groups, and I love to start by just asking clients, what's on your mind? What keeps you up at night? And when I do this, I invariably get the same answers, and usually in this order. The first thing I get is retirement income. Do I have enough? Am I positioned properly, and am I safe if there's a market correction? And then I usually get, what about long-term care? I'm not really sure that I'm okay with long-term care, but I've got some questions and some concerns. Hey, taxes always come up. Have I done enough to mitigate taxes? And then I say, hey, what else? Anything else on your mind? And people usually say, well, I like my kids and I really like my grandkids, and I'd kind of like to leave them a legacy. But did you notice the order? That's the order we get. So what we're going to do today is we're going to talk about how we solve all of those client problems while retaining control and access to the money, which is so critically important these days. So as we go through this, we're going to look at 2 client profiles, and I would suggest as we do this, if you think of a client or prospect, write their name down. So we're hoping that you talk with your Alpine account executive after this, and you can discuss these client profiles. So we're going to take a look at that pre-retiree that's accumulating money for their future, and then we're going to take a quick look at that 60-plus retiree, and we're going to look at what's on their mind and how does life insurance fit in these days. So that pre-retiree, what age? I mean, I would say pretty much anybody up to maybe the mid to late 50s. They're accumulating money. They're looking to build and save for their future. Always concerned about taxes. We're growth focused, but especially these days, I'm a little risk or downside conscious. Different kinds of money. Now, if you look at those on the bullet list, we're probably thinking the top of the list is better. So what are the kinds of money that your clients have access to? I mean, free money, and I'm not talking about lottery proceeds. That's not really a great one, and we're not highly likely. Free money it's the 401k match that you get from your employer, things like that. Tax-free money is municipal bond income. It's life insurance distributions. Tax-deferred money is that annuity. It's the 401k. It's the Roth. And then taxable money is any other securities you have, stocks, bonds, mutual funds. So we like to try to stay on the top of that list as much as possible. In use today, qualified plans, Roths, annuities, taxable investments, and then also life insurance. And so what we want to do here is we have the ability through tools that Alpine can bring to you to demonstrate how life insurance can be a superior option for risk management, accumulating assets, distributing income, and then maybe even living benefits of addressing long-term care kinds of concerns. So what we want to do in the next couple pages is we're going to show you an example of a case study. Now, the thing I want to stress is this is a customizable module you see here that if you want to see your own examples created, talk to your Alpine AE, and we can create these custom for any situation you have. We can create them for a specific client, or we can also create them, for a general presentation to get you comfortable with this. So what we've done here is we're looking at a female age 45. We're going to put in $17,000 a year into a plan for accumulating for the future. With the life insurance, we're running it with a minimum death benefit. We're starting out at a $500,000 death benefit. And then we're also going to put the money into a Roth, into a 401k. I'm assuming we're going to credit and return the same amount for all three. So if we do an apples to apples to apples comparison, let's see how this thing works out. So the Roth, the 401k, that's TDRP, tax deferred retirement plan, and it says BIUL 8 is an IUL product. We're all going to credit 6.5%, $17,000 a year premium put in. So now let's take a look at the money as it starts to grow. We're putting in $17,000 a year for 20 years. At the end of year one, you see that the Roth has about a little over $17,000. The 401k has over $18,000. And then if you look at the life insurance, the life has a little bit more than $15,000. So why is that? That's because we've got $500,000 of life insurance. So that life policy is doing double duty. It's going to accumulate tax-deferred money, but it's also going to provide $500,000 of tax-free death benefit should something happen to that primary insured. So we're definitely covering the risk of the family. But that's not really surprising because you would expect the life insurance to lag a little bit in the accumulation phase. If we go out 20 years at age 64, we've run this with 20 annual premium payments. You see the Roth has $657. 401k has $702,000, and then the life insurance has accumulated $620. Again, it's not surprising because in year 20, if that insured were to die, there's $1.1 million of death benefit. So now let's take a look at distributions. This is where some of the differences start to happen. What we're doing here is we are distributing the same amount of money from all three. We ran on the computer solving for income out of the life insurance that could be sustained to age 100. So we're solving and we've come up with $59,436 a year of distributions out of all three. Then what happens next is a little bit surprising. The Roth runs out of money in year 37 at age 81. The 401k runs out at age 85. And then the life insurance continues to 100. So people often ask me, well, how come the life insurance can go longer than a Roth? And this is, I'll give you one quick product nugget. There's two things going on. There's a guaranteed interest rate crediting in the policy. There's also in many life policies a variable participating loan, which I'm not going to geek out too much for you here, but there is a way to allow the loan balance to still be earning or crediting based on the performance of the index. There is arbitrage between the loan charge and the crediting of that index. So we can make it as simple, as complicated, or as conservative as you want. Well, just know we can do this for you. If this intrigues you or you just want to lift the hood and know, how does this really work? That sounds too good to be true. Talk with your Alpine account executive after. We can make you comfortable with it. We can show you how it's used. Then if we look at distributions, the columns don't really line up, but we've pulled out about $1 million out of the Roth. We've pulled out $1.2 million out of the 401k, and we've pulled out almost a little over $2 million in the life insurance. So for the life insurance, it's a better way to grow money and distribute because of the tax-free nature. The products worked extremely well. We can alter the assumptions, but then the big picture for the life insurance is death benefit, tax control, downside protection. So even though the markets are all-time highs, nobody can time the market, and you still really need to be in it. All right, let's pivot. Now let's take a quick look at our retired client. What's on their minds these days? You know, we took a look at it. It's, do I have enough money in retirement? Is my income safe? Is my principal safe in a downside correction? What about long-term care? Huge concern. And then, you know what? Love my kids, really love my grandkids. I'd like to do something for them. But what many of you have probably seen in the last maybe 10 to 15 years, we did an awful lot of gifting into policies into a guaranteed UL. But that was money that was gone and done. And now today, a lot of clients are a little bit more reluctant just to part company with those annual exclusion gifts of $14,000 a year. So if I could have my cake and eat it too, if I could do something for legacy for my heirs, but if I could still retain control and access of those money or those dollars and that money, that's what I'm looking for. So that's what we're going to take a look at here. So the typical client we see, 60 plus, they have sufficient income. They've got some of those dollars set aside, and you may refer to them as a couple different ways. I like to call them your now money, later money, or your never money. The never money is the money you don't need. You might refer to it as your live on or your leave on money. But a lot of clients these days either have a lump sum asset that they don't need, kind of earmarked for the kids, but they just kind of feel good knowing it's there. Could be a CD at the bank, could be a bond, a municipal that they don't really need, or frankly, it could be some cash flow they don't need. It could be part of a pension that they don't need to pay the cable bill. It could be required minimum distributions for clients that are 70 and a half. What we're starting to see is it's a continuation of that strategy that many of you have used for years. We take the lump sum or the income, we leverage it for the benefit of the life insurance for the family and the kids, and there's no way you can do or accumulate more with other kinds of places to put money because of the leverage of the life insurance. In 2018, where we're seeing increased interest in life insurance is the living benefit side. It's the chronic long-term care style of distributions or liquidity that's available. It's the retirement income distributions that could be available should your client need it. So it's multiple benefits that we haven't really seen before. So let's take a look at an example. What I did here was I just used a single premium example. So I ran a client, a male age 65. You can see Rocky Balboa, you know, the last movie I saw when we put this together. Ran a $250,000 single premium. Now this, like I said, will work extremely well if you're using an annual cash flow or an ongoing contribution. They both work really well. What we're doing here is these are dollars sitting off to the side. We're trying to leverage them for the benefit of the heirs with retained access for your client. So we're always going to look at this in terms of what are the living values should I need something while I'm alive, and what is the death benefit or what would pass to my kids. So we're starting with a $250,000 single premium. And then looking at year one, at the end of year one, we have the ability with a waiver of surrender charge option to give you full access without surrender penalty at the end of year one. This is something that we can use. It's an optional feature. So depending on your client's needs and interest, we can do this or we can leave it off. And that's, again, this is a little bit of detail. We'd probably leave you to talk to if you want to know how these work. The North American product works real well here, but you know what, frankly, Alpine has some really good, good other companies that do this. So talk to your Alpine AE about this, about structuring how that would work. So you see at the end of year one, we've taken that 250 and we've grown it to 261 as far as living benefits for your client. We've also got a death benefit of 475. What we can do here, similar to what I showed you before, is we can use that modeling program and compare putting these dollars into insurance versus other kinds of places that you would deploy money or capital, and we can quantify your clients' living benefits and death benefits, and we can help you make the right decision on what's the best place for them. Surrender values at life expectancy, you see that 250 has grown to 633,000. and the death benefit is $769. It's beyond what we have time for here today, but we're able to quantify internal rates of return on the cash flow and the future values for you. So as many of you are, you get involved with financial management, with asset management, with asset allocation and things like that as part of your practice in advising your clients. We can get as specific as you want to quantify time value of money, and that'll come down to internal rates of return and cash flows. So we also can, for that engineer type client, we can get as specific as you want, and we can also get as specific as you want for you to help you with identifying, and really for your own benefit, is this a good place to put money? We feel it is, but let us prove it to you. So talk to your Alpine AE there too. All right, so let's now talk a little bit about the biggest risk to clients' retirement and maybe your assets under management: long-term care. I can tell you from personal experience, my grandmother lived to be almost 100, and we lost her about a year ago. She spent her last 3 years in a nursing home, and we went through about $12,000 a month. So I live in Connecticut in the Hartford area, and it was a enormous drag. We were lucky Grandma had money to cover it, but you know what? It was a big deal. So now let's take a look at long-term care. I'm going to take the next couple of minutes and we'll walk you through some statistics that may not be new to you, but what we're looking at here is high-level conversation on long-term care. If any of you want to talk about this after in more detail, please contact me, contact your Alpine AE. Many of you that have worked with long-term care over the years know that traditional long-term care insurance has been the workhorse product. It's faced challenges in the last several years because the market's changing. The market is contracting as far as carrier participation. There's been rate increases. And even just at the point of talking with clients, traditional long-term care is a difficult sale because of it's the use it or lose it proposition. It's fairly expensive. So life insurance right now with riders for long-term care liquidity has become one of the leading sources for solving the long-term care problem. We as an industry still sell lots of long-term care, traditional standalone insurance. You know, the life insurance is really something that has very much taken on and is a big part of what we do solving that problem. So some statistics you guys have probably seen over the years, looking at long-term care planning. Life expectancy today is 79.5 for men, 83 for women. In my case, my grandmother and my family, we live a whole lot longer. The longer you live, the more likely you'll need some care. And then the statistics you've seen, it's the 70% chance that someone will need long-term care. For a couple, it goes up dramatically. You've seen the statistics. What about cost? You see here are some average costs available. I can tell you, as I shared, in some of your Northeast and your bigger metropolitan areas, it's a lot higher. So how do you cover the long-term care risk? Love to ask this question in the conversations. So if I were to talk to clients, I would ask them, how are you going to cover long-term care? There's basically two ways. You can self-insure. You can set enough money aside yourself. You can put it in savings. You can put it in investments. But you have to do it in a way that you have reasonable certainty that that money will be there. So what that means is, said in English another way, you've got to put it in safe, low-yielding, fairly liquid places. Now, another thing you can do is you can pay someone else to cover the risk. And now what I mean there is we can buy insurance. So as we know, traditional insurance is you set a lump sum aside, usually between $5,000 and $10,000 per couple. That locks you in. If you don't use the insurance, well, you've invested the money in the policy, similar to your homeowners and auto. You know what? My house didn't burn down. I'm really not unhappy about that, but it's the same thing. Using life insurance for long-term care coverage really gives you the best of both worlds because you have the access and benefits very similar, in a lot of cases, really similar, almost identical to long-term care benefits and how the policies work. But you've got the ability that if you don't need the care, you don't exercise liquidity and you don't dilute the earnings on your policy or the accumulated values. All right, let me give you an example. And before I get into an example of how the rider works, let me just share with you, with life insurance, your Alpine AEs can help you. There's the regular long-term care riders. There's your chronic illness riders. We can help you what the differences are. There are some policies that we do full underwriting for long-term care. So with life insurance, we do mortality underwriting. For long-term care disability, we'll do morbidity underwriting. So there are also other kinds of policies where we do not do long-term care underwriting, and then the clients are only needing to be screened from a life expectancy or mortality perspective. That's the way this example policy that I'll show you is going to work. So for example, here, you can accelerate on that policy. Let's go back to our example. It was the 45-year-old female, $500,000 death benefit. You can accelerate up to 24% of your death benefit per year. What we're doing here, to give you an example, is the first year of acceleration at age 85. We will elect to accelerate $50,000 of the death benefit. There is not a unit charge or an additional charge for the insurance at the time of issuing the policy, but there's a slight or small discounting when the money comes out and is distributed to the client. So there's either in some riders you pay up front an additional fee, on other riders you don't pay and you have a haircut or a slight discounting when the money is distributed. So in our example here, at age 85, we will accelerate $50,000 of death benefit. $44,815 is what is paid out to the insured. And then at the end of that year, you've got a $450,000 death benefit. Next year, we accelerate $50,000 again. $45,188 is a check that's written to the insured, and you have a $400,000 policy. And end of the third year we're doing this. Now we've accelerated $50,000 again. $45,551 is a check that's written to the insured, and we've got a $350,000 death benefit remaining. So here we can give you more examples on how this works, and we can walk you through it. So this really, folks, is what I would say to kind of tie it all together. Life insurance right now is still obviously as important as it's ever been for death benefit, for protecting families. But right now, from that accumulating assets and distributing income standpoint, it really is probably one of our best solutions for that accumulating assets client, because we've got the downside protection, the tax control, and the ability to distribute the money. For that retired client, this is probably the place in 2018 we're seeing the largest interest for life insurance, just because it's that Swiss Army knife. We're able to offer the tax control. We're able to provide a place for the clients to still accumulate money with the downside protection. We're able to have leveraged or increased liquidity for long-term care. We're able to also have liquidity in case of retirement income shortfalls or portfolio downturns. So it's a way for the clients to be able to have, truly have their cake and eat it too. So, with all that said, I just want to thank you very much. You see here on the screen, that's, again, my name's Steve Zimmerman. That's my phone number and email. My internal associate's name is Brandon Borgstall. We're available to assist you in conjunction with the Alpine account executives. So I would suggest, if you thought of any clients, I'd give your Alpine AE a call right away while these ideas are fresh in your head. Let's take a look at specific clients and prospects. Let us put together some samples for you, either some marketing materials to walk you through the story, or let us build a case study to give you specific examples of how this stuff works. And just thank you so much for joining us. We know that your time is your most precious asset, and we hope you have gotten something out of this to go back to some clients and maybe even start some new conversations with prospects. So thanks, Chris.
Steve, thank you very much. And thank you, everybody, for attending. I know that he went through a lot of information very quickly, and that's one of the downsides to the webinars. On the positive side, as I said, this is going to be recorded and will be available on our website for anybody who's registered. It's www.alpinebrokerage.com. If you do not have a login, just click on the register button and we'll be happy to get you one. The other part is, again, reach out to your Alpine account executive, and we would be happy to go through this in more detail to help you develop individualized ones for some of your clients, because the best way to start understanding this, to start working with it and implement it into your practice, is to actually start doing it yourself and start working through cases that you have on your desk. So once again, just feel free, give us a call. We'll be happy to walk you through all that. Our main number here is 866-777-2006. And if you don't know who your account executive is, or you don't know their extension, Star Bay at our reception desk will be happy to look that up for you and help put you in touch with them. Once again, thank you very much. Thank you, Steve. Thank you, everybody, for attending. We look forward to seeing you in future webinars.